All right, welcome everybody to the Ultimate Advisors Resource Podcast. Today we've got a very special topic, I think. Everybody's been talking about it, at least on LinkedIn. Everybody's arguing about it on LinkedIn, of course. That's what people do on LinkedIn. But anyways, I've got a special guest here, my father, Ralph Pence, former chief actuary. He calls himself the information czar, whatever. I don't think Maddie knows what the czar means, but anyways, former chief actuary, been around this, probably invented IUL is what he would say, and got some insight on some of this stuff. And we really want to talk about it because what grinds my gears, so to speak, about this whole thing is sort of the mainstream media reaction to it and how they're positioning this as IUL being a scam. The attorneys, I think, really leaned into that. They want obviously more lawsuits around this. But is IUL a scam, I guess, is the underlying question. And what happened in this specific case with Kyle and Samantha Busch and Pack Life and the agent and all that?
Yeah, there is a lot of angst and anger about it, and I can't blame the media. What do they like? They like to sensationalize things, so it's not a surprise that they're going to try to sell whatever it is they sell. And also, you didn't mention the video that the Bushes put out. You can really tell not only are they angry, but they're impacted. I mean, they lost quite a bit of money,
Yeah,
and it's understandable that they certainly want to put blame wherever they feel that they can put it
right.
in order to justify the decisions that they made. And maybe based on what they were presented, they thought they were making a good decision. But as you peel it back, clearly there was some fault. But I think it's a stretch to say any product is bad. These products were all reviewed by all the states. They were approved by the states. And there's a lot of people that bought those exact same products that are very happy with the results. So I think you have to look more at the specifics of the case before you jump to any conclusion about this being, quote, a scam.
Yeah, exactly. And that's what's extremely frustrating is like I look on the internet and you see like people who are investment guys saying, see, I told you IUL's a scam, cash value insurance is a ripoff. And then you got whole life people out there saying you should only do guaranteed whole life because of this. And then you got IUL people arguing about the product and all this other stuff. But I think when you get down to it, this is maybe a different story because you're exactly right. If this policy was funded properly, set up normally, um, designed properly, like you ordinarily would for an accumulation type of strategy, they wouldn't have failed. In fact, they probably would have been ahead of the illustration given how the market's done over the last 7 years.
Yeah, there's no question about it. I mean, I actually own an IUL, and it's not that particular one, but it's performed very well, and it's done all the things that it is supposed to do. And there are a lot more people that are very happy with their decision to utilize life insurance, both as protection and liquidity and future income streams. And so I think you ought to look at the specifics of the case to see what went wrong. What can we learn from this? And how do we prevent this in the future? And I guess the point of today is to really try to find what did happen and
Yep.
what could have happened to prevent it.
Yeah, and I will add one more thing to this. It's almost like if back when Bernie Madoff stole all the money from the people, if the media's reaction was, you know what, investing in the stock market is a scam because Bernie Madoff scammed people through investments. I mean, that's
Uh,
almost what this that would be analogous to what they're doing with the IUL.
yeah, they're certainly lumping everybody in the same boat. That's for
Yeah, it's
sure.
not right. So, you and I both read the lawsuit documents. It's like 50 pages.
Right.
Um, I also read Bobby Samuelson's take, which he I guess has some insider information. I haven't talked to Bobby Samuelson. I just read his article. So what do you think happened?
Well, and unfortunately, what it looks like happened is probably greed.
Mm,
The products are built to be flexible, and you can dial your commission with that particular product. The default dialing is 50% base, 50% non-commissionable face amount. for those that follow insurance. And the more base you have, the less efficient and effective the policy is. And this particular agent decided to increase the coverage beyond the minimum that it could have been and increase the percentage of target, making it virtually 100% target commission. That raises all of the charges in there, and it was basically underfunded. Anybody that markets life insurance as a potential income product down the road knows that the way to optimize it is get the least amount of insurance possible,
Yeah.
thereby maximizing the cash value growth.
Yeah, and normally, like most companies, the higher the death benefit, the higher the target premium. The lower we get that death benefit down, the less the agent gets paid, but also the lower the expenses are internally.
Precisely, yeah.
And Pac Life's got this weird feature that you mentioned where the generic or the default is a 50% base, which is commissionable, and then a 50% non-commissionable death benefit. Well, why in the world? And that's market, right? Like that gets the target to about what market rates would be.
Right.
Why in the world would PAC allow the agent to increase beyond the commission beyond what market rates were? I mean, that's just an insane take, it seems like.
It it puts the onus on the agent to find the right balance, but it also allows for an agent that perhaps doesn't care as much about the results of the product than his own pocketbook. And so it allows greed to come in. And there is no rational explanation for doing that, to have 100% base. There's no rational other than I want to get paid more. There may be a rationale for paying less premium in year one
Right.
if there's a plan to increase the premiums in the future, but that doesn't match this particular case. And in fact, it was sold as a policy that was going to be paid up in a few years. And even that is not the most effective design. It's
Yeah.
better to spread it out 5 at least, maybe 7, and even a 10 pay is going to lower the death benefit down, increase the cash value, and therefore giving you more income down the road. But what this particular advisor or agent sold was something that looked good enough based on the illustration. The other factor about the Pacific Life PDX product,
PDX, PDX2, they're very similar. I
yeah,
don't know that there's a big difference.
is as a result of AG 49, and not to get into the weeds with AG 49, they were able to illustrate higher returns by adding more leverage into the product.
Yep.
And so on paper, it looked very successful in that on paper, you're going to win every time in an illustration. You're going to hit those multipliers. And it allows for, you can run a 5% illustration that's yielding 6%. That's not logical.
Yeah, your gross rate of return is 5.5, but your IRR is 7.
Yeah.
How did that happen?
It can happen, and it's called leverage, but leverage cuts both ways. What makes this case even more disturbing is the client or agent did not put the funds into the accounts. It was in the fixed account, therefore guaranteeing a loss.
I know that part shouldn't be understated because the fixed account was earning like 2.25%, and this is according to Bobby Samuelson. But you're going to lose on that. I mean, there's no way with the charge structure of Pacific Life, and even in probably a normal policy that didn't have the charges, if you're only earning 2%, you'll be okay. Like you probably won't make a ton of money, but it's not going to be, put 10 million in and lose 8 million.
Well, if you overfunded,
If you overfunded
this
it,
was a
correct.
combination of max commissions and underfunding.
Yep.
And no performance or virtually no performance. So it was doomed to fail from the beginning when it was put in the fixed account.
Now, if you read the lawsuit, they talk about using a slat in this, and I think the design or the initial thought that they had for these people, the Bushes that is, was actually pretty decent. I mean, it was some decent planning.
Yeah.
It's just the execution and the policy was not great. I mean, they had a slat for each other. Samantha had a slat that was for the benefit of Kyle, and vice versa. Yeah, and a slat is spousal lifetime access trust, which basically is getting these policies outside of their estate so they can avoid estate taxes when they die, but still allowing the spouse to have access to the cash values. So it's a really efficient way, right?
Yeah, and I can imagine that was part of the attraction of the design that was put together because on paper, this satisfied a lot of, it checked off a lot of boxes. Estate tax free, income tax free income, protecting the family. I mean, he's a race car driver. I mean, the probability of death's a little bit higher for a race car driver. So it checked a lot of boxes. Unfortunately, it was designed in a way that it was not going to work.
Well, and that's another thing that we hadn't brought up as well. Kyle's policy had even more drag on it than Samantha's because of a roughly $5 flat extra per thousand.
Yeah.
And the face value on this policy was 44 million, I think.
It's either 44 or 45. Yeah.
45 million even so I per thousand $5 flat extra. So I'm gonna have to do the math in my head, but that's some substantial drag, and that's every year that drag is happening.
That's right. That's right. The charges as a percentage of premium were well over 50%, and you're not going to accumulate
No,
enough interest in the future to make that a paid up policy, and it cannot happen at 2.5%.
it cannot happen at the fixed account. There's no way, especially with the $5 flat extra, with the all base commission, with only funding to target premium. I think in Bobby's article, he discloses that the plan premium was roughly 1.5 million in Kyle's policy, and the target happened to
Just
be
happened to be
exactly the same.
yeah. That's certainly doomed from the start, and unfortunately not monitored properly because some of that should have been caught well before it got into the $8.5 million loss.
Well, and that's another thing is what where is the compliance? Where are the regulators that allowed a product like this to be designed like this? I mean, the regulators got all on their high horse about loan spreads and rates of returns on IUL, but you're going to allow a company to put a feature in a product that allows the agent to dial the commission either up or down. Where's the regulation? I mean, that's insane.
Well, I'll play a little bit of devil's advocate. If you look at, say, whole life, I mean, there's some people saying this wouldn't happen on a whole life. Well, you can sell a whole life all base. And what does that do? That maximizes the commission. Or you could use a paid up additions rider to absorb some of the premium,
True.
thus lowering the comp and doing more for the client. And the argument would be each client is different, their needs are different, so we need that flexibility.
True.
Now, does it need to be that flexible? No, I think it's a matter of degree
Yeah.
that this occurs. The solution would have been simple for Pacific Life is mandate that you can't do more than 50% of base. That would be a way to control it. But even that is a slippery slope. If you did 50, well, why didn't you do 40% base
Well, that's
or
the
20?
question, right? Yeah, why if the default's 50-50, but you can go down to 10 or 0 or whatever the minimum is, it might be 25, but it doesn't really matter. If you can go down to the minimum, almost every agent should be involved in a lawsuit as to why they didn't move it down to the minimum.
Well, if you extrapolate that, then why do car dealers give you different deals? You know, you have your sticker price, below sticker. Some people buy it above sticker.
Good point.
Why is that? I mean, it is a negotiation at some point, and I don't know that it is the right to take that away,
It's a good point.
but there is extremes.
Yeah, and I think Pacific's commission structure is an example of one of the extremes.
I would say I don't know of anyone that has higher targets in the IUL space. Certainly not in the top 10 of IUL sales.
No, no, nobody. No, they definitely have the highest targets, and in some cases, I've looked at illustrations. And it's like how does this work out other than the bonuses and the multipliers and things like that?
Yeah, well, it doesn't. I mean,
Well, in this case, it didn't,
it
obviously.
it didn't, and it's hard to think that Pacific Life isn't somewhat culpable in this particular case. But again, I don't know all the facts. This is all
This
hearsay.
is all speculation. A lot of this is based on the commentary from Bobby. If you read the lawsuit, it's pretty heavy on like the fact that I mean, it kind of goes back and forth, and it really hits on like the investment thing, like calling the insurance an investment.
Yeah.
It in the lawsuit also it does talk about the commission thing with the ART.
Hmm.
So the base versus ART and the fact that the agent didn't do that. But you know, and it hits pretty heavy on Pac Life's charges as well in the lawsuit.
Yeah. Yeah. We don't know all the facts of this particular case, but we do know that Pacific Life's IUL had high charges that created higher leverage, which is more risk, and also had the feature where you could dial your commission. So we do know that, and we do know that this one in particular was at the far end of the extreme.
Oh yeah,
But your point on selling insurance as an investment, this is that issue has been around a long time.
yeah,
As a young actuary in the 80s, there was a lawsuit against Metropolitan Life, I believe, against agents in Florida selling retirement plans to nurses, and they were calling them deposits, not premiums, and it was a big deal.
yeah.
They were using a regular whole life product at the time. I don't know that the product was good, bad, or indifferent, but there was deceptive sales practices. That is why we have this term called LIRP, Life
Yep.
Insurance Retirement Plan, because we want to make sure that if you are going to sell insurance as a supplemental retirement, you make it clear to the client that this is insurance based retirement.
Well, and that's the problem in like with the product sort of blurs the line in some instances, right? Like the companies have designed these products all around growing cash value. A lot of products, not all of their products, but many products are designed around growing cash value and making distributions. And it's just sort of blurring the line between I don't want to say investments, but a way to accumulate cash and investments, like an investment without the insurance component.
Well, you can't run away from the facts. The fact is that life insurance does have tax benefits associated with it. They're
Yep.
real, they're in the code section. It does have the benefit of growing tax deferred, and you do have access of all your cost basis tax free. And if you borrow against the policy responsibly and don't let it lapse, you can get income tax free distributions down the road. So I don't think it's bad to let people know these are the benefits associated with it, but you do have to let them know. And the Bushes knew that this was life insurance.
And surely they did. I mean, they're
Of
not.
course, they're not hiding from that fact.
No, they had to have known that it was life insurance. I mean, if they, I mean, I don't know what other investment, quote unquote, makes you take a medical exam, but surely they had to do a
Well,
medical
they they
exam.
they they knew it was insurance, but if it were described as an investment-oriented insurance and that, it was paid up and
Mm-hmm.
sustainable after 4 years or whatever period they were illustrating, that is a little bit deceptive and in fact inaccurate. And, obviously, there wasn't any stress testing done in this particular case. If he did, it wasn't in the video that the Bushes put out.
Well, and I guess I go back to what Bobby said, Bobby Samuelson said about all of the money being in the fixed account. If that's true, you didn't even take advantage of the best feature of the whole product.
No, that's malpractice.
Yeah, that's just criminal. I mean, you should sue based on just that. Even if the policy was funded properly, set up properly,
Yeah.
you should sue them because it was just in the fixed account. And I'm surprised that wasn't as prevalent in the lawsuit. I didn't read it once in the lawsuit. I only read it in the article.
Well, true, and again, we
It could
don't we don't
that
know
could
the
not be
facts.
that could not be true.
But you are right. If it is true, that's negligence or however you want to describe it. I doubt that agent said, "Yeah, let's put it in a fixed account for now." I think it was an oversight, and maybe it was a mistake on
Pack
Pacific
Life.
Life.
Yeah, maybe they
We
missed
don't
it.
know, but it should have been caught for sure and should have been corrected, which would have mitigate some of the losses.
So when I first saw this come out and they said, yeah, they put in $10 million, they lost $8 million. I couldn't understand how that was possible because that, if structured properly, that's just hard to believe, you know?
I had the same reaction. I assumed it was maybe premium financed or something
That's
like that.
exactly what I said. I just said it was either
Over levered.
premium finance, the
Yeah.
client paid one premium and didn't pay any more, or the agent scammed them. You know, the agent bumped up the
Yeah.
commissions. But even then, it funded at target premium should break even at least 10 years in, I would think, at least get close to it.
Not at 2.5%.
Not a 2.5. Yeah, good point. Good point. So what what should advisors be, you know, like, because clients are going to bring this up. I actually, you know, I had a client text me right after this went public, and I said exactly that. So what? I don't know that everybody needs to go out and tell all their clients, hey, you know, look at this lawsuit. This is what happened. But surely clients will bring this up or it'll be in the back of their head. And especially for advisors that are prospecting and they're presenting this strategy of overfunded IULs to build up cash value for tax-free retirement in the
Mhm.
future. If somebody Googles that right now, they're going to come across
Sure.
this news story.
Yeah.
So what should they do? Should they preempt it? I don't know. I mean, that's kind of a tough decision.
Uh, I I it depends on your relationship you have with your client. It would be one thing. I don't I don't think it's a bad idea to preempt it to say, hey, if you Google IUL and tax-free retirement, you're going to see some good articles, you're going to see some negative articles. Here's why it's good and here's why it's bad, and this is why I do what I do. This is
Yeah.
why I pick this product. This is how I design it.
Yeah.
And this is how I stress test it
Yeah.
and say, here's what I think you can get, and here's what'll happen if I'm wrong.
Yeah.
And I think that's a reasonable approach. And a lot of good advisors are already doing that, and they just need to keep doing what they're doing.
Yeah. I mean, if you're doing the right thing, which is setting it up at, you know, minimum non-mec or at least, you know, where target premium's half of the premium, you know, these are going to work out just
Yeah.
fine.
Well, let me give you a scenario, and it happened to be Pacific Life. So this is actually a positive statement about Pacific Life. It was a premium finance case that 5 years in, it's actually outperforming what was illustrated. But the client got advice from another advisor saying you should never do premium financing and it's a bad deal. So he stopped the premium payments. And as a result of that, it became underfunded and it stopped performing. And now the whole deal is collapsing. This had nothing to do with bad advice from the agent, and it had
No.
nothing to do with poor product performance. In fact, it had great product performance.
Yeah, certainly.
But the client said, "I don't wanna do what you suggested," and, it got unwound. Now, I think the lesson in that case is if a client doesn't pay what was predicted, you have to show enforced ledgers on what the ramifications of that decision are. And in most cases, if they stay the course that extra 2 years in this case, they would have been scot-free and would have been able to not be in a loss position.
Yeah.
End of the day, this client will lose probably 2 or $300,000, and this was in a trust, and it was for estate planning.
This is not right. I mean, we actually had a situation quite similar with one of our agents, and the client's putting a substantial premium into a policy, did one payment.
Mhm.
Had a client talks to another advisor. The advisor's like, "Do you know how much the agent make on that? And do you know how much the charges are on that? And all this other stuff." Well, now this other advisor incited this client to cancel the policy after 1 year. Client put in, let's just say $100,000. Surrender value is only about 44,000.
Right.
Now that's not the exact numbers. It's actually quite higher than that. But the fact that another advisor, I mean, that's almost malpractice on the other advisor. He could have given him good advice and said, look, just stick with it another 4 or 5 years. You're going to end up all right. I mean, you'll end up in a profit situation. You're not going to lose more than $500,000. Well, more than 50,000, 60,000, you know? I mean, that's crazy.
Yeah. Well, the only way to prevent some of that is communication with your clients.
Yeah.
And try to preempt that by showing,
Yeah.
hey, here's what happens if you stick to it another 3 years, 4 years, or what have you.
Right.
Might not have changed that particular case.
May not have, yeah.
But that's all you can do. I mean, clients can be fickle as well, and they can
change their
swayed.
minds.
They can change their minds, absolutely.
But the bottom line is, in that specific situation that we ran across where the client changed their mind, that has nothing to do with the fact that the validity of using an IUL or anything like that. That client made a bad decision. That was a bad decision, right? I mean, that was a very bad decision, and they lost money as a result of it.
Well, as a percentage, I'm quite certain the more people are happy they bought an overfunded IUL than are not happy.
I'll tell you, we keep track of the original illustrations, and I would say of the people that stuck with the plan, I'd actually be willing to say probably 100% are at or above the illustration.
Absolutely. I mean,
And
we've had a good run.
Yeah, we've had a good run, right?
Yeah.
Like the markets have done well, so of course they've outpaced the illustration. And in fact, even some old like Lincoln policies, for example, where the caps are real low, you go back and you look at the original illustration, it will be almost. And if they did the right thing, did what they promised, they're right on track.
Right.
And it's not a bad tool. It's just in this case, they were definitely. It would seem that the agent was somewhat greedy.
I would say so, and I would caveat that with, but they were allowed to.
But they were allowed to, yeah.
It was permissible based on Pacific Life's policies. I mean, this would have been a high-profile case for any company.
Yeah.
So a lot of senior execs would have signed off on that particular policy.
Oh yeah.
And they would have seen the ledgers, assuming the ledgers were actually what was presented.
And where where is the upper management saying, wait a minute, you know, this guy, this has no ART in it. This is 100% base. This is supposed to be for wealth accumulation. Why are we allowing this?
That's a good question.
I mean, if you do any annuity suitability, they'll question you over every little thing. Where's the suitability on this side?
Well, be careful what you ask for.
I'm not asking for that. Maybe, that was a mistake. So forget I said that. But seriously, I mean, you know, it's
some companies do that.
Some companies do.
Some companies do that.
Yeah, I mean, it's not like insurance is that complicated, right?
No.
The cash value in the future is, you know, premiums minus the charges plus the interest that you get. It's not that complicated.
It shouldn't be, and it's obvious this particular client did not understand what they were getting into.
Either that, or they're a victim of the juiced up illustrations. I mean, that's another factor.
Yeah. Until you see, I mean, unless you were there to see what was actually presented.
Good point. You just don't know.
You really just don't know. I mean, maybe he committed to a higher premium and decided to not put in that much. We don't know.
That is what I thought initially. That was one of my thoughts, was like maybe the client committed to 3 million, 4 million, whatever it was, and just didn't do that.
Right. And assume that it would just simply be linear.
Yeah.
Which it would be if you cut the face down and refund the commission.
Yeah, if he did that, then but he already went through underwriting for 44 million.
Yeah.
So you might as well take that. Something could happen, you know, and
right.
You know, it's a slippery slope, and it's easy to criticize in hindsight, but
there's plenty of blame to go around on this particular one.
Yeah,
sure.
certainly, and I think a lot of it lies on the agent and pack life, but I don't know. So, what should agents do out there? How do you prevent this?
Well,
What do you do?
I think agents should pay attention to what happened here
Yeah.
and make sure that their language they're using isn't deceptive, that you are calling premiums premiums instead of deposits.
Yep.
Shy away from investment talk
Yep.
is one thing, and that lesson has been around forever.
I've been
Uh,
saying that. I think they asked that on the insurance exam.
yeah, so there's really no excuse to do that. You don't have to. You know, this product is good enough without trying to hype it up. It has benefits that no other vehicle does, and it does multiple things. And so sell it for what it is.
Yep.
It's a great tool that when used properly does what nothing else can do.
Yep. No, I agree with that. I think it's a great strategy and something that we've been doing for a long
Well,
time.
the other thing is make sure you understand what you're selling.
That's what I was gonna say too.
Because I guarantee you most people that sold the PDX product had no idea how those indices worked,
Yep.
how the accrediting actually worked. And I heard, and this is hearsay, that one of the wholesalers for Pac Life said this is a trust me product. You know, we're Pacific Life. You can trust the whale. A lot of people do, and they use that as an excuse. Well, it's
Trust me,
Pac
it's
Life,
good.
yeah.
Yeah. That's a good
So
point.
make sure you understand it. I personally would never sell or buy anything I don't understand, which is why I don't have any
I
Bitcoin,
was
by the way.
about to ask that question. Well, and I think another point is because I was just explaining this to an advisor this morning. We have a top 10 IUL chart that we do, and some products are like, 20,000 more in income, and their cash value is lower. And my question I posed to them is, well, why do you think that is? And I'm just like, well, the cash value doesn't matter. It's all about the income. And I'm like, well, wait a minute. You got to understand that these illustrated rates are just that, they're illustrated, and some of these companies are putting in extra bonuses to get their loan spread up so that it illustrates loans better. And once you understand that, I think you can't just chase what the illustration shows. And we've talked about that
Right,
for forever, but
right.
I think this even highlights that even more is don't just look, okay, this number's bigger, well, let's do this.
Yeah, that's unfortunately the illustration has become a crutch, and
I know.
people are falling into that trap. And with AG49, there are products that will outperform one that illustrates better.
Yeah, I know.
It's
I can
just
tell you right
you
now.
can factually know that. And so educating yourself or finding someone that has done the research for you and trust their judgment.
Yeah, you should call us.
Well, there you go.
Thanks for that plug.
Absolutely.
No, it's a serious problem. Like, the best illustrating product as far as income goes may not be the best performing product in real world because they're illustrating a bigger loan spread due to this loan feature, or they have
Right.
this bonus or that bonus. And the reality of it is it's all imagination.
The methodology is very difficult to ascertain if you're not spending a lot of time looking.
Yeah.
There was a company that looked really really good on an illustration a few years back, and I found out that the cap on the loan bucket was different than the base policy.
Yeah.
That sounds innocuous, but down the road, if they drop that, there goes all your spread on that particular loan. You take away that leverage,
Yeah.
then everything gets reversed. Then the cash value is king.
Exactly. And I mean, it's just like, well, I mean, it is what it is. I mean, you've got to understand what you're selling and why it looks that way. Because if you're selling something and you think it's conservative, but they actually baked in an extra 2.5, 2% spread in there, well, now your illustration is more of an average or maybe even above average illustration. And the chances of achieving that are, maybe 25% instead of 50%
Right.
or greater. Like if you have a company that's only showing a 50 basis point spread, the likelihood of achieving that is maybe 90% or whatever.
Right.
It's much higher, and I just made up those percentages, but that's kind of the point.
No, it's exactly right. I mean, I think looking at what is the actual charges that are coming out is important. Yeah, it's important. Do they have good indexes or not? But most of them are pretty standard.
Yep.
And then the loan feature, I just wouldn't pay that much attention to it
Yep.
because it's how much cash value do you have? I think that's far more important.
I agree. And the loan feature, as long as it's a variable loan or an index loan where you can get a loan spread on the index, it's not some wacky, like, we have a separate account that we put it in, and that might have a lower cap or a higher cap
Right.
depending on the time period. As long as it's not something goofy like that, the loan feature's fine. But when you start bonusing on the loans and doing this and doing that, that can be manipulated so easily in the future. It doesn't matter
Yeah.
what it is now.
Yeah.
So,
It's amazing how far the industry has come.
yeah,
I know you don't like my old stories, but back when I was your age, it was a 200 basis points loan charge was the average,
a negative.
negative 200 basis points. So now you've got a positive. That's a 400 basis point swing. No wonder you can get more income out.
Mhm. Exactly. And it almost, well, and in fact, it kind of makes it harder to compare an old product to a new product because AG 49, right? So you take a product that was written 10 years ago. Okay, they don't have any of the bonuses in there. They don't have any of this stuff. So when you run the loans, it's only a 50 basis point spread on an in-force.
Right.
Well, I can go to a new company and get a 2% spread, and then all of a sudden you got double income, and it's like, wait a minute. It's
That's
a
imaginary.
yeah, it's a slippery slope comparing that income number, I think. And anyways, that may be something that happened in this specific case where regardless of how high the commissions were, you go all the way down the ledger to the bottom. Well, look, you got $1 bazillion here and you can take out $1 million of income.
Right.
And is that actually real?
Well, this case it was
In
not.
this case, it was not
It was
true.
not.
So, anyways, any other thoughts, takeaways?
No, I still contend life insurance is one of the best products out there. It has a lot of flexibility. Just like any product, it can be abused.
Yep.
It doesn't matter what product you're talking about. There are investments that are abused.
Look at Bernie Madoff.
So I wouldn't throw the baby out with the bathwater, as they say. But this is going to get some scrutiny. I would make sure you understand the product you're selling and work with people that you trust on the design side of it because it can be complicated.
It is, and there's a lot of options out there, and it's hard to learn all the options, and that's something that we've done is really get into the weeds with this and make sure what we're representing is a realistic view. I mean, you might not want to sell the highest income. You might want to look at some different factors, and there's a lot of great companies out there. It's
There's
just,
plenty, yeah.
yeah, there's plenty of great companies out there to work with. It's just a matter of filtering through the
Mhm.
the tricks and the smoke and mirrors, so to speak. So,
Yeah, I agree.
all right, well, thanks, Dad.
You're welcome.
Thanks, everybody. If you have any questions in the download, we'll include the lawsuit, the actual 50-page document, and feel free to reach out. Thanks.
Great. Thank you.